My parents would tell you that at a very early age, I was intending to do something big. And I'd say things like I was going to be the next Bill Gates when 9 or 10-year-old Mark was walking around the house. And I wrote the S1 and did the roadshow. And we took it public on the NASDAQ in 1999. And we got to about a $4.5 billion market cap in 2000. And so, yeah, pretty heady days for 25-year-old Mark. It was kind of this entrepreneurial dream of going from cleaning bathrooms in a warehouse to ringing the bell on the Wall Street, 5 years later.
This is Mark McNally. He had started 14 companies previously, raised $1 billion plus in venture capital, and had IPO'd at more than $4 billion.
I did 6 years in Army Special Ops, and when I got out, I was looking for my first chance to build a business, and it could have been a taco shop, to be quite honest. Just had to prove that I could build a business and that I had the chops to do what I always dreamt of doing. You're kind of looking for an answer that investors want to hear, or you're kind of trying to placate the executive that just joined. You're not chasing a vision. You don't have a compass. If a company could have 10 million, but I can give them 200 million, almost by virtue of me giving them that capital, their success and their leadership in the market became a reality. I'm pretty strongly on the opinion that if you want to go public, you need to have a very repeatable and predictable business model. It's a very different thing when you start to be publicly traded. It demystifies this idea that, you can go big for anything that you do as long as you got, all the core elements right.
Hey, Mark, welcome to the show. How are you doing today?
Fantastic. Thanks for having me.
My pleasure to have you on the show. Every single time, anybody that I have on the podcast, I ask them one particular question all the time, and that is, what is the context of your life? And how did you end up whatever you're doing today or building whatever you're building today? How's the whole story looks like? How did it all start?
I see. My parents would tell you that at a very early age, I was intending to do something big. And I'd say things like I was going to be the next Bill Gates when 9 or 10-year-old Mark was walking around the house. Whatever the hell that meant to me back then. But I grew up not too far from Silicon Valley. So I guess I was probably within the echo chamber of seeing kind of what was happening there. And I guess I tuned into that early. I did the Army thing first, service thing. So I did 6 years in Army Special Ops. And when I got out, I was looking for my first chance to build a business. And it could have been a taco shop, to be quite honest. Just had to prove that I could build a business and that I had the chops to do what I always dreamt of doing. But I got fortunate and ran into a couple guys in the back of a warehouse that had this idea they could connect buyers and suppliers on this new thing called the internet. And that was in 96. So I joined as employee 8 because I thought it sounded crazy enough. And we scaled it to 800 employees. And I rose to number 3 guy in that company. So everything that was product, strategy, marketing was on my side of the house. And I wrote the S1 and did the roadshow. And we took it public on the NASDAQ in 1999. And we got to about a $4.5 billion market cap in 2000. And so, yeah, pretty heady days for 25-year-old Mark. It was kind of this entrepreneurial dream of going from cleaning bathrooms in a warehouse to ringing the bell on the Wall Street, 5 years later. And that has a tendency to get people hooked on that kind of journey. So I do promise listeners that I built plenty of character when the market corrected itself a few years later, and .com 1.0 was a nice, beautiful explosion. And we found ourselves a good company when our stock fell 90-something%, but we were, Amazon was at 93 cents a share. So I probably should have sold my bike and just bought Amazon shares. But I think when you're a part of something that goes that big at a young age, there's a couple gifts you take away from it, thousands of lessons. I couldn't possibly cover them all, but the biggest gifts for me on that early stage of my journey was the idea of going big was demystified for me.
How's that?
So the idea that you can take something big if you have the right people, the right execution, the right why. And I say that because there's a lot of brilliant people that have this mental block that going really big is something that other people do, right? And I could tell you, for the most part, the team that was pulled that off, it was a bunch of really hardworking, smart people, but nobody had done it before. And so going through that experience and finding the right people and finding the right connections and being in the right place at the right time, it demystifies this idea that, you can go big for anything that you do as long as you got, all the core elements right. So I've always been seeking that in every company I get involved in. I think if we get the why right and the execution right, the people right, that the sky's the limit. And the other big lesson for me early on was just that when you go through such a dramatic wealth creation event like that, I was doing very well for a 25-year-old. My secretary and assistant became a millionaire. So it was just like really transformational kind of wealth overnight when you're part of that kind of experience. But then subsequently, a few years later, you go through this massive wealth decreation experience because a lot of people lost what they had on paper. You learn a lot about people, a whole bunch of things you needed to know and probably some things you didn't want to know. about how people deal with adversity and what people are made of. And again, I call that one of the gifts for me because I'm very focused on the people that I get involved with, and I don't get overly enamored with people's backgrounds or their CVs. I get past that. I want to know what their intestinal fortitude is, what their integrity is, and what makes them up, because there's always going to be adversity in any journey. And I want to know who's in my foxhole with me, So that's really what got me on the track that I'm on now. I've been doing startups ever since because of that first startup drug that I got on. And yeah, I've done 14 startups where I was a CEO or founder or, large shareholder. Probably a couple or dozen where I was a mentor or a small angel investor. So learned a lot along the way. Seen a lot of different paths to great success. I've seen a lot of failures, a lot of patterns in terms of what makes a company work and doesn't work. And I've always just kind of been more and more curious about what is the repeatable lessons and learnings about how to make startups work. And I've been on that passion path for 27 years. And about 4 years ago, I decided to try to encapsulate all that into a model that could de-risk startups and do startups faster and in parallel. It was definitely coming off a midlife moment, 45 at the time. And I was coming off a small exit, and I had the chance to take my first year off in my entire career. And I probably could have before, but it was the first time that I said I was going to do it. And my boys are like 9 and 10. And I had been in a 8 or 9 year path of doing machine learning and algorithms, and that's not very exciting, fun stuff to explain to a 6 or 7 year old kid. So I wasn't very popular. And I made a very conscious choice that whatever I did for the second half of my career, and I really did look at that like two sides of the coin. Everything I'd done up to that point was just training, and whatever I do next is going to be the legacy builder. And so it was really about how I was going to make my boys proud and how I was going to make the world a better place. And that all went into a roundabout evaluation that concluded that startups are still a thing I know best and I believe in, and that the best way I can point at something that I believe needs to exist in the world that could make the world a better place, that hopefully is the appropriate amount of irrational, and I have a chance of pulling together the people and the resources and making it come to life. And so we got busy thinking about how you create a vehicle, which is a venture studio called Nobody Studios, a vehicle that allows us to build companies at scale in an aggressive way with a goal of doing 100 companies in 5 years, and doing it at scale so that we can have the biggest impact in the world, but also take all those lessons and consolidate them into how to make things go faster with less risk.
Okay, wow. I was just taking note. Okay, so this is the follow-up question, and that's the follow-up question, and that's the follow-up question, and there's a tons that I just noted out. So the first one that I want to start us off is there's two questions that I want us to start off of. Let's start with both of them. So one is you mentioned a couple of times, like when you figured out the why, you figured out the people, you figured out the execution, anything can be big. So how do you figure these things out? The why, the people. I think the biggest problem, the biggest mystery is people. Like how the heck you hire the right people, because that's a pain in the ass all the time. So that's one. The second part of the same question is, after seeing all that you have seen, like years and years of experience, dozens of companies that you got involved in, if you have to separate out and if you have to pinpoint a few reasons and you think, okay, so all the successful companies that you've been in or you've been a part of, you've seen them, so they do these three things perfectly well. And the companies that do not end up doing very well, they don't do these things or 3-4 things in the same fashion. What would those be? So the first part is the why, people, execution, how to get that right. And the second part of the same question is what separates a good company from a bad company?
Yeah, great question. So in that year, I filled about 2 journal notebooks with lessons, because what I did is I went through systematically and thought of every company that I've been a part of or very broadly exposed to, and I kind of tried to study what worked and what didn't work. First, on the people point, I think that you're right. We talk a lot about teams. That's not overly original. I think what I've come to believe is that we used to think of like, and again, this is even 20 years ago, where the idea was if you have a checkbook and you're hiring, you can go get what you need and put people in the factory to do the job, right? And I think the world we live in today has a lot more to do with people are attracted to the journeys and they're attracted to the why of a company. And they'll see through all the corporate bullshit, and it's really hard to get them excited about a paycheck. There's a certain amount people need to make to get out of bed and do what you want them to do or need them to do. But if you capture their imagination and they're 100% aligned with what you're trying to accomplish, that's the difference, I think, in people. You're no longer trying to fill a role. You're trying to get the right person in the right role. So it comes down to maybe we thought a lot more about experience fit, right? We need someone that can do this job that has the experience. That's certainly important. But I think passion fit has become more important than ever. Of all the things people can do, of all the choices they have, are they passionate about seeing this come to life? And so you really want to create an army of mini founders. And that's what you used to see in just the founders. They had that passion fit. I usually am looking for somebody at a founder level or an employee level that'll give me that signal that I should be aware of, that they think academically it'll be a good business and they can make money on it. If I'm hearing that, I usually run. I want to hear the passion that this has to, because that doesn't survive. Academically, thinking something could make money, then you're always competing with the next thing that could make money or faster, right? But if you have a passion fit behind it, I think that's more and more important. But I think that gets you to the core of, I'm not so sure we're recruiting anymore the way we used to. I do believe in the law of attraction. And so I think if you really know what you stand for and you vibrate that and you speak about that openly, the right people do come to your journey. They walk in the front door and say, I'm supposed to be here. And you know it immediately, right? And so I do believe that that's, at least the way we think of it, the way I think of it, something that's super important. And it might sound like a nuance or a small difference, but I think it's a massive difference in how you attract people to your journey.
Okay. And either part of the same question.
Yeah. So the flip side is a really interesting one. So, I've had a bunch of companies that I studied that I was deeply a part of that either failed or even had successes, but could have been wildly more successful. Right. And I kind of put them into 3 buckets of failure. And one is a leadership failure, which is if you don't know what you're trying to accomplish and you don't have a vision and you're not really convicted about it, it's really hard in a startup environment because you kind of need that irrational leader, that irrational, naive startup person to see something that no one else sees. And you need them to chase that maniacally, and irrationally until people start to see, oh my God, this could be true. This could happen. If you're kind of changing, and this, I guess my answer to leadership is if you're kind of looking for an answer that investors want to hear, or you're kind of trying to placate the executive that just joined, you're not chasing a vision. You don't have a compass, right? You don't have your North Star, and you're almost destined to fail. Now, it doesn't mean you can't hit the market right, but I just call that more of a scheme or a gimmick than a business. So I do think that at a leadership level, I'm always looking for that North Star vision that, while it has some downsides to it, I'm looking for someone who can learn and can, definitely look to see what the signals are telling them. If I don't see someone with that real strong vision, I know they're going to get pulled so many different ways in the market, from competitors, from investors, and from their own executives. They have almost zero chance to succeed, because when you're doing something new, you need to put a strategy in place that you believe in and have conviction in, and you got to give it time. Now, you don't just bet blindly on it. You got to be this curious, scientist. You got to go back and say, okay, what was wrong with my thesis? What didn't work? Okay, let's pivot. Let's change it. Let's tweak this. Oh, the message was right, but the target was wrong. Okay, let's change the target. You constantly have to be working with getting the original goal right, because you believe that's the right answer. But how you get there, that passion allows you to do all the tinkering it takes. But if you throw out a strategic vision and you say, great, that was a stupid vision, we'll have a new vision tomorrow, you literally just can't survive. You have no time to actually get the original plan to work. You can't even make sure you're hiring the right people to support that vision. You're certainly not making the right partnerships. You're certainly not getting the right investors in place. So again, leadership is part. Culture is another one. I believe strongly in culture, and almost without fail, when I saw a company take a downturn, there was a cultural shift where, I usually say an asshole got involved. It's maybe not always that simple, but something that was a very different change from the culture that got the company to where it's at. And that doesn't mean you don't need to evolve as you grow up. But if you do that at the wrong stages, it's terminal. So it'd be like if you had a very lackadaisical single mother raising you, and at 14, she marries an authoritarian man and he's your stepfather. You're going to be miserable. You're going to resist it. And all this becomes about internal politics, right? And so again, cultural changes, usually because the company is starting to grow, and they're trying to hire people different from what got them there. But you can hire people with different experiences, but you're still looking for a cultural fit, or at least something that's going to be a natural cultural handoff. If you bring people in, they're going to be radically different than what got you there. You end up creating mutiny inside. And again, you're putting all your energy on internal politics versus growth. And then the last thing that I've seen consistently, again, is getting the wrong capital. And it's such a hard thing to say, because as an entrepreneur, you're just trying to find capital. But man, if you get the wrong capital, it's a death. And because you suddenly realize as a startup person, you're no longer really running your own show. In a lot of ways, you have a job and you're reporting to people. And it's really hard in a startup world. I've always talked about this openly, which is there's this really interesting conflict. We talk about innovator's dilemma as a big, successful company that can't innovate the next market. But I actually think innovator's dilemma is more prevalent in startups. Because if you just raised $20 million on this thesis that sounded really good and you're really excited about, and you have a new investor on the board who wrote that check, and 3 months later, you're like, oh man, we were wrong. We should pivot. It's really hard to go into that boardroom and tell that person that you're changing direction. So you have a lot of what I call walking dead startups that are just trying to keep it alive because they raised money and they're trying to keep their investors happy, but they've just lost that incentive or that vehicle that lets them be super aggressive, which is one of the reasons why we're so focused on the early stage startup, because you should be doing all those pivots and experimentations super early stage. And when you bring in the right capital, it should be scaling something that's validated, not something that's still theory, right? And then again, I look for the asshole rule in investors, right? You want a cultural fit. You want investors you can trust. You want people that you can jive with so you can have those discussions and you can make the right choice for the business. And if you ever get a warning sign that someone's going to be the wrong one, it might be painful, but it's easier to walk from it early. And I've done that a number of times in my career. I've done it on this journey, but I can also relatively freshly remember an investor and a person on the board of a recent company that had a lot of hubris and arrogance about how big companies should become and how much they could sell for. And we had a really lucrative offer at the company at an early stage. There's probably $5 million put into it. We probably could have exited for 100 to 200 like that. And the board was very forceful based on this individual saying, you guys are thinking too small if you think that you're not going to build this into $1 billion company. And so they were very arrogant and rejected it. Later on, the company sold for a fraction of that, still a success, but we missed a bigger opportunity when there was less capital involved. And again, I think it was largely hubris, but the only reason why that had influence is because it was the capital that was involved.
Okay, so thank you for explaining all these things in depth. Really appreciate it. Again, plethora of questions. I've heard this thing a lot of many times that, that there's a thing which is called cultural fit. Like everybody talks about that. Almost every founder on the planet talks about cultural fit, and yet we see so many companies have cultural misfits. What exactly is a culture? How do you define, so for example, it's at the beginning, there's a couple of co-founders, employee number 3, 4, 5, or whatever, less than 10 people. Less than 10 people, what's the right time to start thinking and talking about culture? And eventually you'll become a 100% company. So how do you scale that to 100% company?
Yeah, I think culture has to be thought of early on. If it's a new founder, I think it's as easy as thinking about what you stand for, what you want to stand for, how you want others treated and stuff. Like you have a certain DNA of how you want people to operate. If you're more experienced, you have a better vision also of how much you want to grow. I can tell you how important it is. We hired a chief cultural officer as almost one of our first hires, Sejal Thacker. She's a rock star, and anybody who's interested in culture should look her up. But I was following her on LinkedIn for years, liked how she was talking about it. I knew culture was going to be super important to nobody. Reached out to her to connect, and one conversation led to the next, and I finally was like, I want you to join this journey. And she laughed out loud, and she's like, you're crazy. I can hear your dog barking in the background. You're in your garage. It's just you and one person. Why do you need to have a cultural officer? And I said, well, I know how fast we're going to grow. We're doing 100 companies in 5 years. We're going to have, 10 employees, and then 100, and then 1,000. And, this is going to grow beyond my ability to have a one-on-one connection point with all the people who are going to join our journey. And that's where culture, falls off. So there's a phase of every growth where every person who joins the company has exposure to the founder. Or, I might be the founder, but I hire 3 VPs to start, and those are still founder mentality, right? And so people get hired under them. They understand how we think. They understand the culture. They understand who we are as people. And so there's usually not a culture problem, regardless of what the culture is. It's usually when you grow and you start hiring people who are one removed from that kind of founder mentality that you start to have people misinterpreting language or misinterpreting actions. And it's because they don't have the filter to say, wait, I know who these people are. I know what they stand for. And I think that's the kind of thing when you have a friendship or you have a long-term relationship or even a colleague, you can give people a lot of leeway because you really know what they mean or what they intend. But especially in this virtual world where we're doing a lot more text, we're doing Slack, and we're doing other things, it's really easy to misinterpret, right? And so I think culture is important from day one, but it's even more important if you know you're going to scale rapidly. So for us, we from the very beginning made this an important point, but it was have a lot more to do about how we treat each other, right? So I talk a lot about like, we're going to operate at the speed of trust, and our goal is to move fast. But I can't move fast if you don't trust the people around you to have your back. If you say, I'm not sure this is the right decision, but I'm 80% sure, and I'm trying to tell you to move on that decision, say if you're 70% sure, go. You're only going to do that if you feel confident that people around you are going to say, I trust that decision. I'm not sure I agree, but I trust that you thought it was right. And if it doesn't, we'll deal with it, right? So you need this like clear communication, this almost like I got your back kind of mentality. You need that culture, I believe, to move as fast as we want to move. And so we really spent a lot of time talking about that. And also when there's a problem, don't go complain to 10 other people. Don't talk about it at the water cooler. Take it up directly with, where the problem is. Let's try to solve it, right? And so that kind of transparency, that openness, that honesty, but also that trust. And ultimately, a lot of those things I just said are the opposite of politics. So anytime people are like, ooh, this is going to set this person up to look bad, I'm going to somehow set them up in a way, or I could probably rescue them, but I'm going to watch them walk into a brick wall. When you see that type of behavior, people who are political or set people up are the first people that I want out of my organization. So again, I think all that ends up becoming embodied in culture. And I think it's more about how you treat each other and how you make decisions than it is big posters on the wall of your headquarters,
Totally makes sense, sir. I just want to take a few steps back. At the beginning, you mentioned a couple of things. So just, that was a question that I really, really am itching to ask. You said this thing that, if you figured out the right team, you figured out all the right pieces, you kind of demystified the whole big, like you can make it big. Anybody can make it big. And every time you can make it big if you figure out all these pieces. There's two questions / thoughts on that. So one is, in this venture world, I hear this saying quite often, and you must have heard that too. A person to build the company is not usually the person to scale the company. So people kind of differentiate a founder from a CEO, just, for the lack of better words. So what's your thought on that? And question number two is, if everybody can make it big every single time, why second-time founders are preferred to be backed by XYZ VCs, and like people would like to take a bet on second-time founders more because they kind of think like, you've seen, like Mark, have seen like what great would look like, what big company would look like. I've probably not seen that, and they would much more prefer you than me. So two-part question, please.
I don't know. I think that's a little stereotypical and a little bit legacy. A lot of what we've been building around the studio is believing that a lot of what we did the last 30 years is becoming more and more obsolete. And so an example of where that would be obsolete, 20 years ago, you built a software product and you had to hire an enterprise sales team, and you need people to go to trade shows. And there's a very specific way of building a global sales team. Very expensive, but the experience of doing that and knowing how to build that and manage that, that's a unique person you want to hire. Most startup people don't necessarily have that, and you don't necessarily want to do that on the job, right? But today, a lot of businesses that are scaling really fast are growing digitally through digital acquisition and product-led growth. And so the models are changing in terms of, I think it's easier for a founder CEO to make that, transition easier. Plus, if you recognize what you need, you can hire senior VPs to do that thing. I need a senior VP of sales that knows how to do that, right? And there's fantastic examples of, startup CEOs in the last 10 years, 15 years that have made that transition just fine, right? But again, I think it's because while they were threatening an existing industry, for the most part, how they were growing and what they were building was a new paradigm for that industry. So they didn't have to play by the old rules, right? So I don't necessarily subscribe to the startup CEO can't be a scale CEO. I think it has more to do with what that individual's passions are and what their skill sets are. So you could have the skill sets to scale, but it may not be what gets you out of bed. You may just like to do invention and creation. So knowing that means you shouldn't get busy with the scale part of a business. Now, I think there's a lot of startups that have constant reinvention in them, right? Like Uber is a good example, where Uber started out with an idea, but it's quickly was into autonomous vehicles and a whole bunch of new invention, right? Airbnb started out with a simple concept. It's reinvented 6 times along the way. So again, I think that's the kind of thing, or if you're going to have that much of evolution in a business, it does tend to lend itself to a startup CEO who could make that transition more and more. Whereas if you're like, okay, I proved the software product, now the business just got more boring because it's just about scale. That's a good time to hand off to someone who knows that and does that well. But yeah, I do think it's changing. There's some merit to it, but I think it's changing from maybe where the original stereotypes started, 30 years ago.
Okay, totally makes sense. And your thoughts on investors backing second-time founders more so than the first-time one?
Yeah, look, I think second-time founders, again, I think it helps when you know someone has the skill sets and is proven, right? That's certainly a plus. But what I do tend to see when you see second-time founders is sometimes they're more of a hired gun. So it goes back to a statement I made earlier around passion fit. Do I really believe they care about this problem? Or are they just parlaying their first success into another gig, right? So if I found someone that was a first-time founder that really sold me, they had the skill sets and they had the passion fit, but they didn't have the experience, I'd probably pick that over someone who had the experience but not the passion fit.
Totally makes sense. Okay, cool. All right, so just want to talk a little bit about exits and all of that. Like you've done like not one, not twice, like you've done many of them. Let's start us off with two questions. Again, like I don't know like why I always have like two thoughts on every single thing. So please bear with me. So the first one is, what's the right time to exit any business? How do you evaluate, exactly to your point, how do you evaluate that deal at $100 million exit would have been a good one compared to whatever that company become and like whatever the multiples were? So what's a good time to exit? How do you find that time?
Well, I think it's a fascinating thing for you to bring up, and it's kind of astute for you to bring it up. We talk about it a lot in our theses and how we pitch ourselves and how we recruit people, but you don't hear a lot of discussion around it, actually. So I think one of our theses of the studio is that innovation's about to go into hyperdrive. And, we were saying this 4 or 5 years ago, but now you see with like the GPT world, how fast things are changing, sometimes daily. And we believe you're moving into a spot where if you're trying to build a unicorn, again, there'll be unicorns, but 99% of startups aren't going to be worthy of that kind of a path and that kind of capital. And if you're trying to build that, you're basically saying, I'm exposing myself to a 10 or 15 year horizon to actually build a company worthy of $1 billion exit. And if that's what you're trying to do, and you buy off on our premise that the speed of innovations at hyperdrive, then you're actually exposing yourself to 5 or 6 or 7 innovations and disruptions you can't even envision yet. So the risky nature of that kind of plan is more risky than it's ever been. So we actually believe the people who are large and have the capital are going to have to become more and more acquisitive than they've ever been because they can't innovate fast enough. So it actually means the market's going to the smaller side. We are actually more fond of building companies rapid, getting market product fit, building a team, and exiting that company in the mid stage than where I think you could have done 5, 10, 15 years ago in the markets. Again, when I started my career, we had a data center that we spent $8 million on with raised data floors and air conditioning and Halon systems and stuff. Now you just throw that in AWS for $1,000. Like the speed of innovation is way different. And so again, I think that has to factor into how you think about exits. The only way that factors into how you think about exits is how you factor into how you raise money. And so we talk about this a lot in the studio, is that people don't realize, again, the whole industry has been focused on valuations the last 10 years. And you talk to a young founder, they're like, oh, I'm going to raise $10 million on a 50 pre and I'm going to be worth X. That's all they want to talk about. I talk to a lot of these young founders. I'm like, wait, you're raising 10 million on a 50 pre and you're like 4 days old? Like, do you realize you're now worth 60 million and everybody on that board wants a 10x exit? So now you have to find a $600 million exit and you're a week old. What if I offer you 100 million cash tomorrow? You're going to take it? Yeah, I'll take it, but your board won't let you. So I actually believe that if you want to be optimized for mid-stage exits, you have to start with having a disciplined cap table. Raise what you need, execute, laser focused on maximizing the results for that investment, and always be looking for what I said, music stops. Always expect the music stop and say, okay, what would my exit path be right now if the market melts down, right? Now, I think you want to put yourself in the best scenario to have, which is I could have a great exit right now, given the capital that's been invested, but I actually believe we can go way bigger. But I think a lot of people are skating for only the way bigger exit and not looking for those smaller to medium-sized exits along the way. And again, I think you're moving into a world where founders are going to become more and more repeat founders because of the speed of innovation. And obviously the way we think of it, because we're doing 100 companies in 5 years, is we expect to constantly be doing startups. So we don't have to get in love with any one deal. We're always looking at what is the What is the ratio of how much has been invested? Where is it at? Where do we think it can go? And we'll certainly make some bold choices sometimes to hold on to investments for the long haul. But we're also happy to make great, exits for our founders and our stakeholders, mid-stage.
Okay. You dropped a couple of bombs, actually. So I just want to touch both of them, So question number one is, how much money founders should raise? So that's part one. And part two is, I wrote a lot about that, negotiating for the highest valuation is not a good thing. It's actually a curse that you don't know what you're getting yourself into. But from an expert, I want your opinion on that. Why this entire valuation game is something that every founder should stay away from. How much money they should raise and the valuation thing.
So how much you should raise is unique to every business model, right? But what I'll say, what we've broken in what I call most VC scenarios, especially what you see on the press releases and the headlines, is we used to have a really efficient VC process. And I won't say I was a fan of it when I was in the middle of it, but now I appreciate it looking at how we've gotten it wrong. As there used to be very defined, hey, I'm a seed stage VC, I'm a Series A VC, I'm a Series B VC, and there were people who were actually, I'm a Series D and E VC. That's how they thought of themselves. And it was almost like there was built-in checks and balances. Now, a lot of them all went to Harvard Business School together, and they're all buddies, but they're all in different firms. And so when the Series C guy got a call from his buddy who's at a Series B firm, hey, we invest in these guys. They've done everything we want them to do on this stage. They're ready to raise their Series C. It was a warm intro. But for the Series C guy, it was like, okay, I know it's already gone through checks and balances. It's gone through different levels of vetting. It's ready for me to give more capital and scale, but I don't have to get into the weeds the same way the early guys did, right? And so it was actually a really healthy way of seeing survival of the fittest. Certain companies made it through that gauntlet. What happened when we started raising billion-dollar VC funds, and when I started my career, an average VC fund was 50 to 100 million. And now you're seeing people raise $5 billion VC funds. It's crazy. They're not able to do more deals. It's not like they suddenly did 2,000 deals instead of 100. They actually, all they're doing is writing bigger checks. And in order to write a bigger check is you have to give people a higher valuation. So it works like this. You're going to give up 10% of your company for $1 million. So you think it's worth 9 million pre, 10 million post. That's what you go into your coffee shop mentality with. And you sit down with big VC and you pitch them and you show them your early traction and your working prototype. And they go, wow, this is really awesome. The only problem is I'd like to give you $10 million. So you as a first-time founder is like, wait a second, my company's worth 9. If I sell $10 million, you're going to take over my company. No, I can't do that. And you get all flustered and bothered. And the VC says, oh, no, don't worry about it. We're going to value your company at 90 million. So suddenly, a company went from $10 million to $100 million over coffee because they had to make room for the capital.
Yep.
You have this really inflationary value starting at the investor side, which is a conflict of interest, that has nothing to do with what the market would actually offer you. The market is coming from investors, not buyers. So it's really ironic that investors are pricing themselves out of their most likely exits. 80% of M&A transactions happen under $300 million. So I'd say the majority of Series A Silicon Valley companies are already pushed out of the acquisition zone.
Just because of the valuation stupidity.
And it's even more ironic if you want to unpeel how we got here.
Yeah, please.
The VC market was created because bankers don't know how to value early stage young companies, especially technology.
Okay.
So if you were Steve Jobs and you went to Manhattan and said, hey, I'm going to build this new device, I need $100 million, they'd laugh you out of the room because they're like, well, what's your earnings on multiple, EBITDA, and how do we value your organization? He's like, what? I have an idea. And so when you first started to see higher profile exits in the 70s and 80s out of Silicon Valley, a few of those folks said, you know what? Let's start to invest in people that we understand. So it was really the beginning of VC. And most of the VCs were tech founders that had an exit, and they could get into the weeds. They could understand the technology. They could understand the founder mentality. And so they started funding, early stage folks. Well, now the VC world bloomed up into this massive, giant ecosystem with something like 4,000 funds. There used to be like 50. But here's the ironic part. So as they grew, there used to be this built-in handshake, even as early as say 10 years ago, where the VCs took it to a certain stage. And then they handed it off to Wall Street. And in Wall Street, you had the bankers that would do the IPO. And those bankers got an automatic discount on that offering, which a lot of times they passed on to the people who helped underwrite the IPO or actually fund the IPO, which were mutual funds. And so you had this built-in 20%, 30% return on day one of an IPO, which if you look back at mutual fund performance for the last 25 years, was like 12% consistently. And it's because you had this handshake. VCs build early stage companies, Wall Street takes them public. We feed all our retirement funds. Well, Facebook was the first one that took a step back and said, we're not going to go public until we're really ready. We need to build out our financial model, our revenue model. So they said, instead of, and you used to have, the only way you could get the money you needed to scale was to go public. So there was actually no way of getting off that path, right? But then you had this birth of like super funds and sovereign wealth funds writing billion-dollar checks, and you had soft banks, and you had Russians, and you had all different sources of capital. And Facebook raised $3 billion from overseas, all private, and they grew for 2 more years. So when they finally went public, I can't remember what they went public at, but tens of billions of dollars in valuation. Instead of going public at $1 billion valuation and then scaling to 60 billion, they're going out at tens of billions of dollars. And whoever went public at like 60 or 70 billion dollar valuation, you start to see people going public in these crazy valuations. Well, Wall Street was like, wait, yeah, it's worth that, but I wanted to get in at $1 billion like I used to because I was enjoying these returns for the last 30 years. And so Wall Street, which originally gave birth to VCs because they didn't know how to process startups, packed up money and went to Sand Hill Road and other centers of VC and said, we want to deploy money into your VC fund. And the VC said, great, I'm raising a $200 million fund. We have $100 million left. Why don't you do that? And this Wall Street said, well, we want to deploy $4 billion. And VC's eyes got this big and they said, okay, we'll figure it out. And so they created a $4 billion fund to take Wall Street's money. But then all they did was write bigger checks to small companies. And so they actually started to break early stage startups because the inherent checks and balances that used to be in the old system got thrown out the door. Because instead of raising 20 million over 5 stages of financing, you're doing it on day one. And that's actually why we have an opportunity. So our studio is hyper-focused on that early stage. And we actually have those checks and balances inherently in our own system to make sure that what comes out the end of our factory is highly validated, fast-growing, early-stage companies we haven't deployed a lot of capital on, but are very fundable for the rest of the VC machine who are trying to solve that high-quality early-stage problem.
Holy shit, I did not know any of that, or at least most of that. So thank you for explaining that. All right, so a few thoughts on that. So thought number one is, anybody that comes to Nobody Studios, how much money do you actually deploy to them? There's a notion out there that venture studios usually take up like 30% or something like that, spin up a company or something, and then barely invest, I don't know, like 50K, I think 50K, 100K. How much money do you invest in? And second thing is, with all the business, acumen and business knowledge that you just shared, do you think that we need more early stage VCs so they can actually deploy into more early stage companies at a good valuation or not?
Well, let me take that last one first, since you just said it and then it's fresh. Something like 10 years ago, there was 4, 6, maybe 8 unicorns. Now there's like 1,600. And, we've been saying this for 5 years. When it was super unpopular, we sounded like we were really out of touch with the market. But we would say things like, trust me, it's going to blow up and it's going to really suck for employees. And it's going to really, really suck for investors. And I have never said anything other than that for the last 5 years. And now there's 1,400 unicorns raising capital. All of them are cutting back on staff. Most of them are pursuing a down round, which means they're going down in valuation. And so that starts to really suck for founders. So again, having a paper gain for a short period of time is just a paper gain. So don't celebrate the wrong things. Celebrate what is it going to take to make a company viable. And I think we've lost that along the way. Something that's viable is you build a product that really solves a problem that customers are willing to pay for. Period. The rest is a bunch of financial hocus pocus.
Yeah. Totally agree to that.
Celebrating that victory of evaluation, I get it. But here's what I'd say is a perfect world. Let's say somebody thought, I only need $1 million to get to the next stage. And someone comes along and offers them $10 million at a great valuation. If they are a perfect fit in terms of, investor and passion fit, and they bring a lot more to the table, maybe you should consider it. But if it feels too financially driven, use that term sheet, and maybe you go find someone that's a perfect fit that's willing to give you $5 million at a smaller valuation, right? because you don't want to be in a spot where you block yourself out from a potential mid-stage exit, or you bring in so much money that the terms will be ominous. You're going to give up board control and a bunch of other things, right? You still want to be in the driver's seat as long as possible, right? And again, usually bigger checks come with bigger obligations. So I usually use that as the filter. I would say, what is it? You want to be in the driver's seat. You want to be making the choices as long as possible. And you want to make sure that you're partnering or getting in bed with the right people. So sometimes you can use the different people at the table to get actually the right deal done. And if you could tee me up to other questions.
Yeah, absolutely. Another question that I asked was, do we need more early stage VCs? Because what I heard and what I understood is like the same VC fund that you gave an example, that fund was raising $200 million. And they were originally looking for $100 more million from the Wall Street. What they ended up doing is they were getting $4 billion. So now they need to deploy that $4 billion. That does not mean, quote unquote, what you said, like that does not mean that they went from investing in 10 companies to 2,000 companies. They just wrote a bigger check. Is there an opportunity for more early stage funds so they can invest in more companies rather than just throwing $10 million check compared to like, I don't know, $500,000 check?
Yeah, 100%. And I think it's happening naturally. And again, the big funds, I think they definitely have a place, right? They're always going to be valuable for mega scale opportunities once a company is validated. And there are certain business models where the thinking in the last 10 years has been, pioneered by like Andreessen Horowitz and like SoftBank, these kinds of firms where like, if a company could have 10 million, but I can give them 200 million, almost by virtue of me giving them that capital, their success and their leadership in the market became a reality. Right. And I believe there are business models where that's true. So for example, I want to create a ride sharing app that people use anywhere in the world. There's kind of a hard way to do that small, right? And it will be a race, right? You can look at that and say, there's probably not going to be 95 ride sharing apps because at the end of the day, you have a limited pool of drivers and they're going to, be loyal to one or two platforms. And so it's a race to be one of those one or two platforms. So if that's the business model you're in, then you do need to figure out how to marry up to the bigger capital faster. And you probably do need to make a Hail Mary approach to we're going big or nothing, right? And I'm fine with that. So there's a place for that. But again, our thesis is there's 98% of the businesses you can create in a startup world where the exit's not going to look like that and the scale path is not going to look like that. And so I do think you're getting an emerging group of early stage VCs that understand it's great to write $1 million check for a company that scales and exits at $100 million in 5 years. That's a great business. Do that all day long, twice on Sundays, but you almost can't have that conversation with any of the big funds right now, right?
Yeah, that's the reality too.
You'll automatically try to multiply your numbers.
Yeah.
There's also, a huge wave of exits. There's a lot of, wealthy, maybe not founders, but even executives of, big companies have been successful. Who are out there doing their own funds right now. And they're like micro funds. But they are way more agile, and it's kind of more back to where VCs were at the beginning. You're talking to people who have startup experience. They're startup founder mentalities. They understand the technology. They're in the weeds. They bring even more value than just a check. And I think that you're already seeing that. There are hundreds, if not 1,000 plus micro VCs being created, and they're largely led by like one ultra high net worth person. Or maybe two buddies that work together at, Snapchat or something, and they create the small fund. But it's just a vehicle for them to look at stuff they like and invest in, right? So you get back to like more aggressive, instinctual decisions and people who bring more than just capital. They bring a lot of experience and they'll be more hands-on. So 100%, I think that's already happening because the amount of people who are trying to organize their capital in that way, but also as everybody went big, or a lot of the guys went too big, it created this opportunity for the small end. And if you only have $100 million fund, you can't compete at the high end, right? You can't compete at the Uber level. You got to focus on different deals. So I think you're seeing a shaking out, and I do think you'll end up getting a whole new class of people who are focused on the small end, because I think it's healthy. I think it's where the market's going. Now, I think what we believe is you're going to see a lot of those micro funds, and if anybody knows of any, like we see them as natural partners for our studio. Because the way the studio works is we're just looking to grab a company from the whiteboard, an idea, 0 to 1. We just want to get it in the market with some product market fit. We're not the scale capital. So, these micro funds and smaller end funds are perfect for us to be partnership in that we can feed deal flow to them and we're naturally going to hand it off to them, except they trust how we operate and who's behind the origination of that company. And so it's an easier deal for them to jump onto, and they're probably going to see a more sophisticated deal at an early stage in terms of due diligence and, sophistication of governance and legal documents and everything else that you would not normally see just because of the nature of how we do this at scale. And so again, for a micro fund, it could be a really great match made in heaven.
Awesome. Thank you, Mark, for answering all my nuanced sort of questions. I really, really appreciate that. So what we do is we do have a decent big of an audience. I'm very fortunate to anybody who reads the newsletter or listens to the podcast. So we just send them hey, Mark is coming tomorrow. If there's any questions you would like to ask, I get all kind of questions. Some of them you already mentioned. Some are really crappy, so I'm not gonna ask you those. Some are really good ones. So I'll just try to ask you. In one of the podcasts previously, you said you talked about bootstrapping versus fundraising. Who should raise venture capital, and who should bootstrap, and why we cannot mix both?
I think you can mix. I think the mix of both is just as their stages, right? I don't recommend founders raise any professional capital is when they're still trying to figure out what they want to do. So if they have an idea that's directional, right, and they're looking for someone to bet on that, but that's going to allow them to hire people full time to start solving the problem, I personally am turned off by that, and I think it's a big red flag. So I think the right founders will have demonstrated that they're onto something and that they have passion fit and experience fit by tinkering in inexpensive bootstrapped ways, which means you're finding a buddy who can code, or you're finding somebody on Fiverr who can code something up. You're doing a small experiment on Facebook. You posted something on Reddit, and you're able to at least go to, when you're ready to raise capital, this thing is working. It could be 100 times better, but this little thing I built is working. And here's a bunch of people who've already said they like it. And here's a few people who already paid for it. And in that journey, I've got a few people who want to join the team and help it take the next level. You need to be at that level of detail, I think, to be fundable for any stage. Even if you're doing a pre-seed angel round, I think that's what's demanded. And I think a lot of founders make the mistake of thinking, I'm excited about this. I can figure this out. If someone just gives me $3 million and I can pay myself a salary and I can hire a few buddies on salary, and we can go figure this out. And I'm just personally turned off by that. So that's where Bootstrap comes in. I think you have to have time and capital constraints. You have to be willing to max out your credit cards. You have to be willing to ask your friends for money. You have to be willing to do that early stage stuff, because I think of a survival of the fittest. And if you don't show that muscle early on, you probably don't have what it takes to get through all the rest of the things that startups are going to throw at you.
Okay, perfect. Next one is, how do you evaluate ideas for Nobody Studio? At Nobody Studio.
Well, and this can bring me back to a question you asked earlier, but I don't think I answered, which is when people bring us ideas, when we invest or something along those lines. So one thing that's important to know about the studio is that we are passive investors. So we're not sitting around waiting for people to pitch us on ideas and we're deciding which ones we like. We actually are founders. We consider ourselves founders of the companies we create. So more often than not, we've decided to build a company, and we're going down the path of building a company doing a certain thing. And we start to talk to and recruit people who might have similar passion fits, right? Now, they might already be working on something similar, and then we might be convincing them they should join us and combine forces. But we look at it as we're building this regardless, and we're looking to build a team around it. So what we usually put in on the ideas we build is around $250,000 for the first 12 months. But that doesn't include team. So we've got a full marketing, technology, product, biz dev, finance team. And we are founders into all of the aspects of building the business, right? So there's a lot of, if we put in $250,000 cash, we're probably putting in $1 million in services and in-kind work to get something off the ground. Now, there's no limit. There's some companies that require more. There's some companies that'll, get less before they, mainly our main goal is to get it validated and ultimately fundable. And then we might take it to a angel stage or a pre-seed stage, and we're looking for other people to help us scale it from there. But our model works on just continually focusing on that early stage, right? Now, founders that are recruited to things we're already building would have less equity than if they started something from scratch, no doubt. But again, they're joining an idea we're probably already building. But the difference is they get ownership of our entire portfolio. So we offer something really unique to founders that if they fit something we're already doing and they come on, they can get a nice chunk of that company, but they're going to be part of the portfolio equity plan. So if we build and sell something Nuco 40 that founder has nothing to do with, they're going to see their piece of it. So one of the things we crafted really early was this idea of investors are used to this portfolio approach. Make a bunch of bets, some things work. We're trying to do the same thing for founders, because as a founder, you work really hard on a company for 4 years and it doesn't work. That sucks. You got to start over, right? And we're trying to create something that's more of a keiretsu or familial kind of effect. And all of our founders and all of our expertise across all of our portfolio are actively helping each other solve problems. They all are cross-incentivized to help each other, and they're all part of something bigger. So don't think of Nobody Studios as a passive investment structure. It's more of a movement, and we're founders in all the companies we create.
All right, awesome. The host, this is a question directed to me, asked in one of the previous episodes why a founder should not take Sequoia's money. I asked one of the VCs, like, what's your take on that? Like, I think instead of Sequoia, let's just rename that to brand name VCs.
Again, I think it has more to do with business model fit. I have huge respect for a lot of the big name VCs and a lot of people that are there. They're friends of mine. A lot of respect for them. It's just, you don't want to bring a neurosurgeon to your foot problem, right? And so I just think, I really do believe that bringing on the big name or the larger fund VCs, and a lot of the, by the way, some of the bigger funds are starting to do small funds so they can act like micro funds. And so I just think it has to do with partnering with the right fund. Even the brand name itself isn't necessarily the right way to think of it anymore. But again, I think it has to do with how big your company needs to go, how much it needs to raise, whether or not this is a take it to an IPO or 10-year kind of path, or if it's you could do something really disruptive with $10 million invested and sell for $400 million. Like, I think that's the nuance of which is the right capital source.
All right, okay. And the last one is, what successful IPO looks like to you, and why share prices dropped within a week after the company's IPO?
I'm pretty strongly on the opinion that if you want to go public, you need to have a very repeatable and predictable business model. It's a very different thing when you start to be publicly traded. I took a company public at a young age. We were absolutely not prepared for it, but it's even different today than it was back then. Getting into a mindset of reporting quarterly results, it's a very different mindset than a startup, because as a startup and as a founder, you're not pushing somebody to close in May just because it's the end of the quarter, right? Or whatever, March, April, May, June. You're not forcibly closing somebody at the end of a quarter. If someone says, hey, I need a few more weeks and I'm going to sign this deal, as a founder, you're like, cool, yeah, no problem, man. Just can't wait to have you as a customer. But when you're publicly traded, you're doing all kinds of weird machinations and saying, well, can you please sign by this date at midnight? Because you want to report to the Wall Street. And, I don't agree with a lot of the things that Elon Musk says, but I do agree with a lot of things he says. And one thing he says consistently is managing a publicly traded company is a freaking nightmare, and you do all kinds of unnatural things that are stupid. And I agree with that. So if you're a business that's still constantly innovating, or you want their leeway to invent completely new business models and pivot radically, Wall Street's not the place for you, right? If it's going to be lumpy and, like SpaceX, he's kept private for so long because he's like, look, I knew I was going to get the $10 billion contracts from NASA. I just didn't know if it was going to be this quarter or in 4 years. That's a hard publicly traded company to manage. So I think if you get to the spot, like for anybody who knows InNOut Burger, it's a famous franchise here on the West, not franchise, famous hamburger place here on the West Coast. Every time they create a business or launch a new location, you'll suddenly see 50 cars wrapped around the corner, people waiting an hour for their burger. Every single time they open one. That's kind of a predictable business model, right? So they know if I invest X amount in a location and I build that location and I open it, this is what the revenues will look like. So then they can go to the market and say, I need X amount of money to add 1,000 more stores in the next 10 years. That is the kind of thing that you will have a healthy experience as an executive running that publicly traded company. I think that's a prerequisite to even want to rationally go down that path where you're crazy. And then the other reason to do it, and again, there's probably a lot of reasons that you don't need to do it if it's just capital. But if you think you're going to be highly acquisitive, or you think that access to a bunch of creative kind of financial instruments and lines of credit and other things are going to be important to you, then publicly traded there's got a lot of benefits. But again, first prerequisite is, do you have a predictable, scalable business model, right? And there's a lot of ways a startup can do the startup game and then parlay themselves into an IPO. Like, I think my best examples are like Splunk and Tableau from the last 10 years. These are companies that started out, even though they're enterprise software, They didn't go the enterprise software sales route. Like, let's hire a bunch of fancy, shiny teeth guys to go golfing with our CTOs and try to close our deals. They started out with single seat licenses. Download the software, get a trial, use it. If you like it, pull out your credit card, pay $1,200. So they were able to scale, both of them, to almost $100 million in revenue using digital marketing, trials, single seat licenses, right? When they went to Wall Street, both their pitches were not dissimilar in saying to Wall Street, okay, we got $100 million in sales, but we noticed there's 650 single seat licenses at GE. Now we're going to build an enterprise sales team to go convert those to enterprise licenses and convert $500,000 of revenue into $10 million a year. And so now they had a growth plan they could sell to Wall Street that was predictable and worthy of the investment, right? But I think people get the stages wrong. A lot of stages should grow to the next stage. You don't have to bite it all off in one bite.
All right. Thank you. Thank you for answering all of that. So Mark, we do have this one small ritual on the podcast. What we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. So I got a question for you. Also going to take a question from you. So the question that the previous guest left for you was, what's a dream day to you look like?
Well, I really try to live my dream day every day. I would say if I contrast it to where I'm at now, I'm focusing a lot on trying to force balance into my calendar. I spend way too much time on phone calls, and I have come to appreciate that I need the right balance. I love the phone calls. I'm stimulated by them. Most of my team is global, so the phone calls usually involve solving a problem. And I really believe that keeps me getting out of bed, and hopefully will keep me fresh 40 years from now solving problems, So I love that. But I also need to find the balance that there's a space and time for a physical routine, in terms of prioritizing your physical health. I also my greatest skill set, I think, is thinking and pondering and being strategic. And I don't always give the allotment for that. And then ultimately my days always have to end with, quality time with my family. So I actually do a lot of that every day. I get to do a little bit of that every day. And I come home going, wow, I'm so lucky. But I think we always have to focus on the balance. And as passionate, hardworking people, it's really easy to get out of balance. I'm constantly sounding my own internal alarms and having to refigure calendars and stuff to make sure I get that right.
I can totally agree to that. Thank you so much, Mark. Been a pleasure. I appreciate all the time, candor, knowledge, consideration. Thank you so much for that. This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.